Keep in mind, QE is deliberately designed to inflate the prices of treasuries and MBS and bring those rates down. So that was the intention of the program. So when folks say, QE didn't cause any inflation, they're looking in the wrong place.
Welcome to Proven Improbable. I'm your host, Maurice Jackson. Joining us for a conversation is TREY REIK, Senior Portfolio Manager with Sprott USA. Mr. REIK, welcome to the show, sir.
Thanks for having me.
We're delighted to have you here today to discuss the Fed's impact on peripheral markets. Mr. REIK, the Fed is in the process of implementing a dual policy of rate hikes and balance sheet reduction, which appear to have a duplicitous effect on peripheral markets. What are your thoughts on this dual policy, and what can we expect from Chairman Powell during his tenure?
And so I have about 2 hours to answer that question. No, I'm just kidding. There's a lot of information there. I think that Mr. Powell is obviously very capable monetary steward with an enormous amount of experience and great judgment, and I think he will do a great job. I think he's got some difficult parameters to deal with. There is a little bit of a similarity to when Mr. Greenspan first took over his Fed stewardship in 1987. He actually ascended to the position in August and tried to show the world that the Fed was sort of on the case and under control. And people may forget, but about a month later, on consecutive days, they actually raised the Fed funds rate on 25 basis points on 2 consecutive days, and we had a big backup in 10-year yields, and the S&P had been doing extremely well, and all things looked to be in really good shape. And of course, we had the fall of 1987 very soon thereafter. So we have a lot of similarities insofar as Mr. Powell has just taken over, and the market has a tendency to test new chairmen. We've had this backup in 10-year yields. The S&P is doing well, and we have a chairman who seems to be focused on showing the market that he is in control, and so we've had these rate increases. So a lot of similarities there to ponder. I think that Mr. Powell will do, as we have written in past communications, that the history of Mr. Powell's public statements, and now that the minutes from a lot of these meetings are coming out, the extended transcripts of the meeting, Mr. Powell, since he ascended to the Fed, has been a fairly reliable critic of QE programs, especially towards the QE3 stage. He ended up voting for QE3 as a Fed governor and permanent voter because that vote came up in his freshman year, and generally freshmen don't rock the boat too much, but his public statements and the ones that are coming out from these extended transcripts are, he argued fairly vehemently against the benefit of QE3 asset purchase along the line of reasoning that the market would always expect more, and that we were that the Fed was starting to encourage risk taking and the search for yield, et cetera, et cetera. So now that he has become the Fed chairman and we have these large amounts of debt outstanding, I really do believe that he will go as far as he possibly can along the telegraphed lines of the scheduled balance sheet reduction. The Fed announced back in September of this past year that they would roll about $10 billion per month off the balance sheet in Q4 of last year, and then that would increase by $10 billion per month each quarter thereafter, meaning the monthly total in Q1 would be $20 billion, and the monthly total in Q2 would be $30 billion, $40 billion in the third quarter, and then theoretically by the end of this year in the fourth quarter, $50 billion per month. The $50 billion per month, I'm pretty good at math, times 3 is about $150 billion per quarter, or a run rate of $600 billion. Mr. Bernanke was fond of saying that every $200 billion or so of QE was equivalent to about a 25 basis point rate cut when it was QE. So one would assume that in reverse, that equates to something on the order of about a 25 basis point each. 200 billion of rolling assets off the Fed balance sheet should equate to something like a 25 basis point rate hike. So if we are at a $600 billion annual run rate in balance sheet reduction by the end of the year, that would mean that there's 75 basis points of tightening just from the balance sheet reduction. And I think everybody by now is fairly aware that the Fed's dot plot on average predicts about 4 rate cuts in the current year, implying 2 more for the balance of 2018, and another 3 or 4 next year, and believe it or not, another 1 or 2 in 2020. So that's the telegraph policy, and as I mentioned, I think Chairman Powell will do, especially given that he didn't support a lot of the asset purchases originally. I think he will be as dedicated as possible to try to follow those policies.
Let's discuss how the Fed is or will have an impact on the peripheral markets, beginning with emerging markets, which I like to term as third world economies. Does the Fed fundamentally grasp the dynamics of the situation?
Interestingly, there was an IMF conference that was hosted in Switzerland a couple of months back, at which Chairman Powell was invited to speak on the topic of the impact of Fed policy on other countries and how they can control their own fiscal economies in the environment of Fed monetary decisions. In other words, can emerging markets and other countries still run their own fiscal policy when the Fed is involved in changing its monetary policy? This gets to the Triffin dilemma, etc., in terms of whether any country can issue the reserve currency for the world, because it sets up a situation where internal demand for dollars is not always in sync with external demand for those dollars. So at this conference, Mr. Powell raised a few eyebrows in the assertion that monetary policy of the Fed and its impact on the rest of the world is vastly overrated. I think that having watched that tape, it's interesting. It's on the Swiss National Bank website. I would encourage everyone to take a peek, because I noticed discernible facial expressions of surprise by the other folks on that learned panel, because quite frankly, Mr. Powell made a few statements that we felt were fairly wildly specious claims in terms of the lack of impact of what the Fed's done recently on global monetary affairs. So what Mr. Powell is pointing out is that since the late 90s, when emerging markets had one brand of challenges, such as being linked to the dollar and not having sufficient foreign exchange reserves, there have been changes and improvements on the governmental level in a lot of emerging markets in relaxing those pegs to the U.S. dollar and building up FX reserves to deal with currency pressures. But what this ignores is that debt outstanding in emerging markets has roughly quadrupled over that time frame, say over the past decade, from about 5 trillion to 20 trillion. So while there have been some improvements on the governmental level, the actual dollar-denominated debts that are outstanding have continued to spiral upwards. So I think that some of the things that Mr. Powell is stating as positive developments are more academic in nature. And if we look at the percentage of debt to equity ratios for corporations, say in the MSCI country indexes, the average is way above where it was in the late 1990s, and it's more broadly based. So Brazil, Turkey, China, India, Poland, Mexico, Chile, Argentina, South Korea, Taiwan, these are all environments or economies that have had an enormous increase in debt outstanding, and the dollar-denominated portion of that has recently been estimated by the BIS to be, believe it or not, 11.4 trillion. So if we have 11.4 trillion of dollar-denominated debt overseas, about 3.7 of that, by the way, in emerging markets. It is a mathematical certainty that when the Fed starts to tighten, there is going to be a direct deleterious effects on the economies of emerging markets. So I think the highest dollar-denominated debt to GDP economies are Chile at 33%, Turkey's about 22%, Mexico's 22%, not an unimportant trading partner, and Argentina about 20%. So in those countries, Mr. Powell can say, anything he wants or claim whatever he wishes, but as the Fed tightens liquidity for dollar funding around the globe, there is going to be pronounced pressure in those countries, and I think we're starting to see that in recent months.
Let's shift here to global financial institutions. My first thoughts are bailouts and derivatives. What concerns do you see here, and what type of response can we expect from the Fed?
Mm-hmm. Mm-hmm. So it's interesting. The global financial institution issue with respect to Fed tightening has clearly been largely limited to the plight of Deutsche Bank. So what's going on with Deutsche Bank right now is really very different than what's going on with any other global institution. And obviously there's some unique mismanagement issues, at Deutsche Bank. And so I think that most investors who don't own Deutsche Bank shares are prone to say, well, I don't own it, so it doesn't affect me. And it hasn't spread to these other global financial institutions. Now, what's funny about that is even though you may not own shares of Deutsche Bank, that isn't going to help if Deutsche Bank, further hits the skids, because Deutsche Bank has a $157 trillion CDS book, which is 2 times global GDP. So whether you own the shares outright or not, everything that you do own is certainly going to be affected by the status of that derivative book. And that's just the CDS part of their derivative book. The other thing that's interesting is if you broaden this analysis to what the Basel-based Financial Stability Board terms as systemically important banks, which is a fairly widely used term. As of, a couple of weeks ago, the percentage of systemically important banks trading more than 20% below their recent peaks, which is essence placing them in a bear market, included 41% of the total. So I won't read the list here, but it does include things like the Agricultural Bank of China and Mitsubishi, Bank of China, Credit Suisse, Prudential. So the list is lengthening rapidly, and once again, I think there's a bit of cognitive dissonance to assume that these types of dollar liquidity pressures aren't spreading because they are.
Let's make the conversation here more U.S.-centric, focusing on U.S. corporate credits. There's this sophism that corporate balance sheets are in great shape. Let's focus here on companies just listed on the S&P 500. How accurate is this statement?
That's a great question. So we are all aware, I think, vaguely of a thinning in market ranks. We happen to be talking in the middle of the FANG reporting season, and Apple's doing well and Amazon's doing well, Facebook not so much, and we really have narrowed the focus on these massive companies that, quite frankly, do have a lot of cash. And since everyone's focused on this small group of companies and they have a lot of cash, there is this conclusion that all companies are in great shape. You asked to focus on the the S&P itself. So all corporate cash balances entirely in the United States measure, according to the Fed's Q1Z1 report, at about 2.6 trillion, and that is in fact a new all-time high. But total corporate debt also is hitting new all-time highs at 9 trillion. So if we take the 266 and we subtract the 9, actually corporate cash net of debt registered in the first quarter, once again, this is according to the Fed, not according to TREY REIK, an all-time low of negative 6.4 trillion. So a pretty simple equation, just corporate cash, which everybody is focused on, 2.6 trillion minus total debt, in the first quarter of this year registered a new all-time low of negative 6.4 trillion. When you narrow in on the S&P, the S&P has about the 500 S&P corporations have 1.9 trillion of that 2.66 trillion total that the Fed measures. And if we look at who owns that 1.9 trillion, the top 25 companies in the S&P hold 56% of it, and the top 50 hold 68% of it. So that's 50 of 500 have 70% of the cash, and the bottom 250 hold next to no cash, on the grand scheme of things. So the cash is concentrated in a very small group of companies, which of course are the ones that everybody spends most of the time on in this FANG type environment that we're living in the last several quarters. What people aren't focusing on is there's about $1.5 trillion now of corporate debt rated junk, and another $3 trillion rated one rung above. Not to mention about $1 trillion in levered loans, which we're getting back to almost no covenant protection. So we have about $5.5 trillion of hot potato debt, which stands directly exposed to any deterioration in corporate credit trends. So, of course, we haven't seen a huge surge yet in defaults, but if you look at junk bond yields and any other sort of sensitive measure, those are starting to hook back up pretty rapidly.
Hearing you discuss the number of issuers in the S&P 500 that actually hold cash reminds me of Pareto's law, which also ties into my next question for you, which is U.S. consumer credits. Does the automobile sector remind you of subprime?
So the automobile renaissance, or at least the renaissance in sales and revenues and earnings of the past 3 years, I think this is fairly well documented, has been based on extending the length of loans and reaching further down the credit scale for borrowers. So a larger and larger portion of auto loans are now 7 years long, believe it or not, which is kind of an amazing fact, because obviously no matter what rate you're borrowing at or amortizing, after 7 years, you're going to have a lot of upside down vehicles. And so the trend in the most recent 2 years has been to take that negative equity in cars that are being traded in, both in the used car and the new car market. And I don't have the numbers right in front of me, but I think it's fair to say that somewhere in the 30-40% range of all new car purchases where there is a loan involved in the trade-in are underwater, and that equity is being tacked on to the new loan. And obviously when you had rates at 0-ish%, that type of behavior, while I think it's fairly reckless, is doable because frankly the payments remain low. But now that we're ratcheting up Fed funds from 0 to 2, that's a really, really big difference, a big delta in this type of strategy being workable. And so a lot of this credit has stopped being created. And if you look at any of these subprime classes in the past 2 or 3 years, they haven't really matured. These credit pools haven't had a long time to mature, but they're already facing default rates far higher than at the peak of the financial crisis. So now total auto credit is roughly $1 trillion, $1.2 trillion, is obviously much less than the $10 trillion in total mortgage credit at the peak, of the real estate boom into the 2007-2008 period. So it's about a tenth as large, and a lot of the bad credit is centered in even smaller areas of that total $1 trillion pool. Nonetheless, it is certainly, this brings up, another observation, which Stephanie Pomboy at Macro Mavens first taught me, and that is that a lot of people take solace in the fact that debt service ratios remain low. So, broadly speaking, the Fed's debt service ratios take, disposable income, and they aggregate that, and then they take the debt service, required for revolving credit and car loans and different measures, even take into account, apartment rent, leases, all these things. And so we take debt service ratios aggregately, and we look at disposable income, and the ratio is very low. In fact, it's near historic lows because A, there has been some growth in income, and B, rates are very, very low. The problem with that is that looking at the intersection of aggregate disposable income and aggregate debt service speaks to precisely no one, because one group of Americans has most of the debt and the debt service obligations, and a fairly mutually exclusive group of Americans have most of the income, and they're not the same. So your stress levels at things like, subprime auto, et cetera, are going to be, much faster and much worse than anything that will ever be telegraphed by looking at things like the aggregate debt service ratios. And I think that's really an important point.
A correlation I see, 10, 15 years ago, I was buying real estate and there was no income verification. And I'm starting to see that now with auto loans. It's the same process that they were using 10 to 15 years ago. It seems like we don't learn. History repeats itself. And that's something I don't ever hear really mentioned there, is that, again, I want to restate that here for our audience, is you're actually now able to get loans, auto loans in particular, with just, stating your income without verifying that you actually have the income there. And that's, really one of the reasons why we had that catastrophic bubble 10 years ago.
Yeah.
Now,
our anecdotal evidence, I think, suggests that that's all hitting a wall. In other words, the loose auto terms, and that's in percent of autos that are going out in lease type of arrangements. That's really plummeting, because leasing again works really, really well in a low interest rate environment, because the cost of money is really the only cost, and if that's cheap, you can put cars out for lease at really, really attractive rates, and that's really hit a wall as well. And I think there's certainly a lot of evidence that the leasing pools that are coming due this year and next year are going to really take a hit out of bank earnings, because the used car market is very soft, and so I think the whole auto thing is literally hitting the wall this year.
Regarding credit card debt, what can you share with us about U.S. personal interest payments?
Well, I think that people forget how quickly rising credit card interest rates affect consumer solvency here in the United States. So, when the Fed starts to raise rates, sometimes we look at the Fed funds rate as something that, once again, doesn't really affect, us, but it has had, obviously, an immediate impact on the interest rates charged by credit card companies, which are now up around 15.5%, and there are very, very strong correlations between increasing this rate and, obviously, personal interest payments. But there's an immediate connection, too, to delinquencies of revolving credit. Once again, it's sort of the peripheral type stuff that gets hit first. For example, the 60-day delinquency rate of subprime auto loans, all lenders, in February this year hit 5.8%, significantly above the financial crisis peak, which was right around 5%. Personal interest payments, non-mortgage, are already at new all-time highs. And I've even noticed, and I've put forth a fairly strong correlation to when the Fed started raising interest rates and what's happened with the personal savings rate, which has collapsed in, say, the past 6 months. So as these rate hikes start to take hold, and things like rising interest rates charged on credit cards, it puts a severe crimp on the peripheral credit scores of U.S. consumers, and I think you're already seeing that in a lot of different spots. So for Chairman Powell to continue to increase the Fed funds rate, he is going to have to endure knowledge of the fact that he is causing an enormous amount of stress in the more challenged portions of the U.S. consumer population.
It'd be interesting to see how that comes to fruition and what his response will actually be. I'd be remiss if I didn't ask you this, but how will tariffs in a trade war affect the Fed and the peripherals? And can you provide us with an example?
So it's interesting. Probably the question that I've gotten the most over the last 3 to 4 weeks, from reporters, et cetera, is, why isn't gold doing better? Because keep in mind, that's what I focus on most of the time. But there's been this view that, given the fact that tariffs are, bad, that gold should be doing better. And I think that frequently with gold, at least, people have a tendency to fall into knee-jerk sort of reasoning. And while it is true that tariffs are bad for global GDP and potentially inflationary, in the long run, et cetera, the immediate impact of tariffs, at least in this iteration, has been commodities have really gotten walloped. So really beginning June 1 with the imposition of the steel and aluminum tariffs by the Trump administration, the commodity complex sort of started to underperform dramatically. And then I think it was on July 10th in the evening when the Trump administration announced its plans for another $200 billion worth of Chinese goods to have 10% tariffs, which in the last 48 hours, President Trump seems to be telegraphing a willingness to put 25% tariffs on those $200 billion worth of goods. The commodity complex has really, rolled right off the map on the 11th of July, the morning after the announcement of those 200 billion in incremental 10% tariffs. That was the worst day for the Bloomberg Commodity Index since 2014. And gold is involved in it's involved in almost every commodity index. In fact, it's the largest single component of the Bloomberg Commodity Index at 9.2%. So there is a sort of a tractor beam pull on gold when the commodity complex is performing as poorly as it has. On that day, the 11th, after the 10th, the evening of the 10th announcement, the average metal in the Bloomberg Commodity Index, zinc, et cetera, was down. Copper were down, in excess of 3%. Oil was down 5%. On that day, gold was down 1.09%. So one could make the case that gold, in fact, is acting as a store of value, precisely as it should, by being a little bit less volatile than some of the other commodity components. The way that a lot of this, can work back to affect, I think, the general markets a lot quicker than people realize. You asked for an example. A good example would be that in Mr. Trump's efforts, President Trump's efforts to show he can and will be tough on Russia, there were a group of tariffs introduced on certain Russian oligarchs back in April, and the firm that took the biggest brunt of the sanctions that were announced in early April 6th, I believe, were on Rusal and its leader, Mr. Deripaska, who's a close Putin ally, and Rusal happens to be the world's largest aluminum producer, about a 7% global market share, and I'm sure that President Trump's advisors pointed out that this would be a good company to target because, by taking 7% of global aluminum out of dollar, denominated markets, that would be sort of a double whammy to help the impact on domestic producers of aluminum and steel in concert with the tariffs that he had already imposed. So, Rusal was chosen. Not going into all the details, the bonds promptly went no bid, and the equity in Rusal Hong Kong listed shares collapsed about 72% in the period of a few weeks. So this is an event which clearly didn't get on the radar screen of most domestic investors who are going home every day excited about Google and Amazon's new heights. However, Mr. Putin seemed to take offense to the fact that one of Russia's most important corporations and one of his close friends was being targeted, and it turns out that we now know that in April, Russia sold a little over half its total treasury holding, $47.5 billion in the month, and we now know that most of the rest of the holding was sold the next month in May. So Russia pretty much liquidated $100 billion worth of treasuries in a 2-month period. In April, of course, that was the first time the 10-year yield poked its head above the 3% barrier, since December 2013. And it's just interesting that in retrospect, that 35 basis point jump in 10-year treasury yields in April may have had as much to do with perhaps some ill-advised, because the Treasury is certainly in the process of reconsidering how draconian they want their Rusal sanctions to be. But it's certainly possible that the Rusal sanctions had as much to do with that, eye-popping jump in 10-year Treasury yields as expectations for economic growth or inflation. So we're definitely getting to the point where some of these peripheral events are starting to have blowback to very large and important asset classes.
Now, if I'm not mistaken, Russia, when they dumped those treasuries, did they not go out into the market and share that they're going to purchase gold?
There were some stories that pointed out that the reduction in the treasury holding, especially the $47.5 billion a month, in comparison to Russia's gold holding, made gold a larger portion of foreign exchange reserves than treasuries. The reason I don't focus on that too much is that anyone who has followed Russia closely is aware of the fact that Russia has methodically and meticulously added to its gold reserves pretty much every month for the last 10 years, and certainly in the last 3 years, very, very large. And I just read a story this week that Russian gold holdings are starting to rival Soviet era holdings in gold. So it's such a methodical increase in their gold holdings. I think it's a little unfair to say what that $47.5 billion went to purchase gold. The portion that they've been directing towards gold accumulation each month remained roughly the same. It's just that the cumulative total of the amount of gold on the Russian central bank balance sheet exceeded the treasury total for the first time in a very long time because of the big decline in treasury holdings. Where the rest of the $47.5 billion went, my guess is that it went into sort of a Russian version of QE to stabilize bonds of not only Rusal, but some of the big Russian banks that were under a lot of pressure as well, with this threat that Rusal was going to be sort of locked at. Anyone who did business with Rusal in U.S. dollars was going to be sanctioned. So that put a lot of pressure on the banks too. And I would bet the lion's share of that $47.5 billion went to sort of a Russian version of QE. The Fed took or printed money and directed it at very toxic amounts, Bear Stearns, et cetera, balance sheets in our first example of QE. And I think that what Russia, more than likely, first of all, we have the advantage of being able to print dollars when we buy toxic assets from the Bear Stearns balance sheet. Russia obviously doesn't have the latitude to print dollars, so they had to find them to buy and stabilize dollar-denominated obligations of these banks. Keep in mind, aluminum is priced in dollars, so there was an order book for Rusal that all of a sudden was threatened in terms of where those dollars were going to come from. So they had to find the dollars somewhere, and very clearly the Treasury holdings were their biggest pile of dollars, and I believe that's why they were liquidated, and I think the proceeds went to stabilize these dollar-denominated obligations of banks and Rusal itself.
Trey, what keeps you up at night that we don't know about?
Boy, asking a gold guy that question, you're likely to get a tidal wave. But I really think that the biggest thing that is being missed by consensus and by markets and by the financial media is the amazing degree of inflation that the Fed has miraculously been able to foster in financial assets, at least to date, without causing CPI-type inflation. So I will go to my grave really never understanding how the Fed has been so successful in channeling the inflation that they keep in mind. QE is deliberately designed to inflate the prices of treasuries and MBS and bring those rates down. So that was the intention of the program. So when folks say, QE didn't cause any inflation, they're looking in the wrong place, because it was designed to inflate financial asset prices, and it was remarkably successful. And I think, when stocks reach highs of the past 2 to 3 years, a common refrain or explanation is that expanded valuations are rational because of why? Because we have low rates. And now that the Fed is raising rates, and on the long end we seem to be flirting with the breakout of this 35-year down channel, as you know, equity investors are nothing if not flexible. And so while for several years they would cite low interest rates as the reason to justify premium valuations, now that rates are rising, the common frame is usually, well, but it won't matter that much. And at some point, both the short end for what the Fed is doing and at the long end of what the 10-year's been doing, this is going to have probably in a very short period of time, overnight, suddenly, whatever you want to call it, a big impact on financial asset prices. And the measure that we look at, which really is an eye-popping measure, is the Fed's own measure of household net worth. So in the Z1 report, which comes out quarterly, one of the things that the Fed measures is household net worth. And it usually gets mentioned with, GDP and total debt, household net worth. There's 3 or 4 things that usually get mentioned out of the Z1. This is one of them. Well, if we look at the first quarter of 2009, household net worth was at $54.5 trillion, and GDP was at $14.1 trillion. And if we fast forward 9 years to the first quarter of 2018, GDP had increased $6 trillion from 14 to 20 trillion, and household net worth had increased 46 trillion from 54 to a little over 100 trillion, 500% of GDP for the first time in the history of the United States. So what that means is that for the past 9 years, household net worth, or wealth, if you will, in the United States has been increasing 8 times faster than output, or GDP, for almost a decade. And there's a lot of things that I don't know or can't predict, but one thing I know for certain is you can't keep increasing wealth 8 times faster than output in any society forever. So I think that that household net worth number, which is really stocks and bonds and real estate minus debt, is a number to really focus on, because the increase in short-term rates and flirting with this 3% level on the 10-year, pretty soon that is going to have a very, very outsized impact on this incredible generation of household net worth, or inflated prices of financial asset prices. And I really think it will surprise people how quickly those levels can adjust on the downside.
Well, it's already surprising to hear that right now.
Yeah, and how does gold fit into that? Just as a last footnote, well, when financial assets are falling, obviously that's a time that gold is a good store of value, or people desire to get a little money out of the financial system. And when that starts to happen, the Fed will, as it did with QE1, QE2, Operation Twist, QE3, the Fed is very likely to respond, maybe not with a QE decision, but some sort of policy. And as they say, sometimes it's the medicine and not the disease. That will be very gold bullish as well. So both in terms of a downward revaluation of enthusiasm for U.S. financial assets, and the resultant rationalization of debt that will entail, having something that can't default or be debased like gold outside the financial system will all of a sudden look a lot more palatable than it may today.
Well, sir, we'd like to thank you for a very comprehensive interview. Last question for you. What did I forget to ask?
Well, we didn't focus as much on gold as I think sometimes you and I, like to chat about. And, the question in my mind, quite frankly, is with gold here at, 1225, that type of thing, what is, going to change between now and the end of the year that has the potential to put a little bit more spunk back in gold markets? And I think the answer is recognition that the Fed is going to change its telegraphed balance sheet policy in terms of that scheduled uptick in balance sheet reduction, 10 billion per month. And it's one thing for me to cite, credit stress and peripheral stress in emerging markets, but it's very different when the Fed starts to send signals that they're concerned about the impacts of their sort of dual policy objectives as well. And in June, at the June FOMC, the Fed increased the rate that it pays on excess commercial reserves. It's commonly referred to as the IOER, which is essentially the excess reserve interest rate. They increased that only 20 basis points during an FOMC meeting when they increased Fed funds 25 basis points, which doesn't sound like much, but the reason that they did that is there's already such a growing pressure for commercial banks to find and fund, their reserves at the Fed. Keep in mind, when the Fed prints money and buys treasuries from Jamie Dimon and Lloyd Blankfein, that money stays on, the Fed's balance sheet as excess commercial reserves, and everybody's happy. But when we start reducing the Fed's balance sheet, there is, believe it or not, an outsized effect, about 1.5 on a decline in commercial banking reserves, which are required, and those don't grow on trees. So we're starting to see commercial banks bid up the Fed funds rate, which is essentially the cost of reserves, what they pay the Fed, for borrowing money, at a faster clip than the Fed intends them to do. So, for example, the way the Fed controls the Fed funds rate these days is they have a target range. We used to have a specific rate, and they would intervene every day. Now there's a target range, which is that 25 basis point spread, and the Fed likes Fed funds, the effective Fed funds rate, to be right at the midpoint of the target range. Well, a couple of times in early June, because the pressure on commercial bank reserves, on funding the required reserves, is increasing, the U.S. commercial banks bid up Fed funds to within 5 basis points of the top end of the Fed's targeted range. If Fed funds trade above the targeted range that the Fed sets, that is somewhere between an embarrassment and a credibility hit to the Fed. You can choose which way you want to look at it, but it's certainly nothing less than an embarrassment, and certainly as much as a credibility shot that the Fed really doesn't have control of Fed funds. So what they did is they lowered, or they introduced for the first time ever, a gap between the interest paid on excess commercial reserves and Fed funds itself, to try to induce banks to compete less for that funding source for reserves. So to me, it sounds wonky. It is wonky, but it's important because it demonstrates that the Fed is cognizant of the fact that by reducing its balance sheet, they are already impacting liquidity in ways that they perhaps didn't perceive. So I don't know. To me, it's pretty obvious that they're not going to get anywhere near the $2 trillion or so that people think that the balance sheet, is heading towards. And I've started to read things in recent weeks by noted economists who suggest they may not get that balance sheet below $4 trillion before they abandon balance sheet reduction. Balance sheet reduction, by the way, to date since October is about $179 billion. So it'll be interesting to watch between now and the end of the year if the Fed is able to stay on track with that telegraphed balance sheet reduction. That is the type of event that I think will start to sway consensus back, to our sort of view that it is not likely that that rate increase and balance sheet reduction program that has been telegraphed is going to transpire as advertised. And I think that'll start to put a bid back in the gold market.
These are certainly going to be some interesting times under the tenure of Chairman Powell. Mr. Reik, tell us about your services at Sprott, and if someone listening wants to get more information regarding your work, please share the contact details.
Sure. So Sprott has, I think, the most, I would say without a doubt, the most investor-friendly bullion vehicles in the marketplace. The Sprott physical bullion products, largely gold, but silver and platinum and palladium, have a redemption feature which permit investors to turn their shares in individually for the underlying metal. And the other thing that's different about the Sprott bullion products is that they are eligible to U.S. investors for long-term capital gain tax treatment. Some of the competing and leading market leaders there do not have a redemption feature and are not eligible for long-term capital gain tax rates, and instead are taxed at the 28% collectible rate for bullion and collectibles and coins. So I think that's a great way for anybody to get started with a bullion investment. We have some products at Sprott that are, I think, smarter ways to look at equity ETF opportunities in both the large and small cap arena. And then what I'm focused on is individually managed separate accounts of gold miners, and we'd be interested in speaking with anyone about a separately managed, actively managed equity account if anyone has the interest. My email is treik@sprottusa.com, which is TREIK @sprottusa.com, and anybody can give me a ring if they want to talk about gold equities generally or some companies in particular. And my phone number is 203-656-2400.
And for our listeners, to help streamline the emails, please put in the subject line "proven and probable." Last but not least, please visit our website, www.provenandprobable.com, where we interview the most respected names in the natural resource space. You may reach us at contact@provenandprobable.com. TREY REIK of Sprott USA, thank you for joining us today on Proven and Probable.
Thank you for joining us today on Proven and Probable. Remember to like and subscribe for more conversations with the most respected names in the natural resource space. Check out our website at www.provenandprobable.com. The information presented on Proven and Probable is provided for educational and informational purposes only, without any express or implied warranty of any kind, including warranties of accuracy, completeness, or fitness for any particular purpose. The information is not intended to be and does not constitute financial, investment, or trading advice, or any other advice. You should not make any financial, investment, or trading decision based on any of the information presented without first undertaking independent due diligence and consultation with a professional broker or competent financial advisor.